Welcome, everybody. I'm Jim Allen, Senior Financial Planner here at Anchor Bay. So, welcome to our monthly webinar. If someone wouldn't mind, just give me a thumbs up if you can see the screen okay and you can hear my voice. Make sure everything's working properly. All right, looks like we're good to go. So, our topic tonight is going to be how to use your home equity during retirement. So this is one of the bigger issues that we see when we're working with clients that are nearing retirement or in retirement is like, you've got this large asset. Uh, what are you going to do with it? And, when you're dealing with a home, oftentimes it's a case where this isn't simply a financial decision. There can be a very emotional decision. Maybe you've lived there a long time, you've raised your children there, etc. And so there can be a lot of emotion that can go into this decision. And oftentimes when you're dealing with, say, a married couple, you could have widely differing opinions on what you should be doing with the house. And so this is one of the more complicated areas. I'm going to kind of go through pretty much everything you need to know about what you can and can't do with your home during retirement. So topics, we're going to start with aging in place. So let's say you want to stay in your home. Can you realistically do that? If you can't, are there things you can do so you could stay there? Those kind of things. Then we're going to talk about one of the most common questions we get is paying off your mortgage. I mean, should you pay off your mortgage when you go into retirement? Is it a big deal? Is it not a big deal? So we'll cover that. Then we'll talk about a topic that's kind of controversial, reverse mortgages. And they're just a tool in the toolbox. We're going to give you our honest opinion on, what they do and the pros and cons. Again, we have no skin in the game, whether a client uses a reverse mortgage or doesn't use a reverse mortgage. And we'll talk about potentially trading down to maybe a smaller, less expensive home, once you're empty nesters, etc. And we'll also talk about the tax issues if you go to sell your home. And then finally, I think something that doesn't get talked about enough is maybe the decision to rent rather than buy. So let's talk about your various options for living arrangements in retirement. So the first one is you could stay in your current home. Like I said, you could age in place. Maybe the home's a single story. You're able to get around. You have a social network in place, and you plan on staying in that and making it your forever home for as long as you physically can. That's one option. Option two would be, okay, the house is too big, the kids are gone, the upkeep and the maintenance and everything is just too much for us. We're going to sell and trade down to a condo or a smaller home or a senior community or whatever. Next would be, we're going to sell our house. We're just going to rent, and we're going to use those sales proceeds to pay the rent. And we'll talk about how that could work. Then the next one would be, potentially you're going to move into a retirement care community where, isn't necessarily assisted or memory care. Maybe it's just independent living where you have things like social activities and your meals are included, all of that. And so, those are options. And a lot of those you can transition from independent living to assisted living to memory care all in one facility. And then another option that, is common in some cultures and is certainly an option is to live with family members down the road. So you got a lot of different choices and flexibility here as to what you can do with your living arrangement. And as I mentioned before, the housing decision is both a personal and financial decision. Okay, so if we're going to talk about aging in place, you're now 80, 85 years old, you're still in the same home. What are the issues you're going to have? And so, the first one is, getting around at home. Ideally, you're not living in a two-story home. And, there are things you could do to mitigate that. But also, how are you going to get around town? If you're not able to drive anymore, what's transportation going to look like? How are you going to get around? Do you have family members who can take you places? Are you going to have to use like public transportation, whatever? Safety concerns, the risk of slipping or falling and, breaking a hip or something is very real. And so, we've got to look at what are the safety issues in the current home, and then, the housing concerns. So typically what you're going to do if you're going to age in place is there are plenty of like home safety checklists that are available. So things like, do you need to now have a walk-in shower or walk-in tub? Should you have grab rails? Do you need a lift on your staircase? Those kind of things. And then, getting help, like preparing meals or doing the gardening and all of that kind of stuff. There may be things that you can no longer do yourself that you're now going to have to hire to do for you. So you've got to build that in. And then finally, the financial cost of staying in the home. What it's going to cost you to make the home safe for aging in place versus one of the other options like downsizing or renting or moving into independent living or whatever the choices are. So the first question you want to ask yourself in terms of your home is, can you age in place? Will you have that support network? Who's going to get you around when you're no longer able to drive? Who's going to get you to your health care? Is the health care close to your home? Maybe you live out in a remote area and the nearest doctor or hospital is an hour away. Is that going to be an issue if you have health issues? As I mentioned before, can the home be modified to age in place? So you could have an elevator, you could have stair chairs, you could have ramps, bathroom handrails, walk-in tubs, all of that kind of stuff. That stuff can be done. But then it begs the question, is that going to be cost effective for you? And you got to take into account, do you still have a mortgage? And what's that going to cost? And regardless of whether you have a mortgage or not, you're still going to have property tax. You may have, homeowners association fees. You're still going to have upkeep and repairs. I mean, there's still going to need to be painting. Appliances are going to have to be replaced. Roofs are going to have to be done, all of that. Sometimes an option is if you got a house that you want to stay in, there's 3 or 4 bedrooms, to kind of help offset some of these increased costs. Maybe you rent a room or 2 out, and maybe that gives you, a little extra support, not only financially, but also, personally. So you've got someone else in the home. So if something happens to you, there's a person there to get help or take you to a hospital or something like that. So those are all questions you're going to need to ask as you make the decision whether you can age in place or not. Okay. And so, that's question 1. Do you want to stay in your home? Is it feasible for you to stay in your home? What do you have to do to it? The next question that it's always a biggie is, should I have a mortgage in retirement? So, we're all of a certain age here, I think, on this webinar. It was pretty much drummed into our heads by our parents. It's like, the house has got to be paid off when you retire. That isn't necessarily true. It's financially, does it make sense to pay off the mortgage? Emotionally, would it make you feel better to have the mortgage paid for? Or, some people it may be, okay, great, my house is paid for, but I don't have any money in the bank. And so you could be house rich and cash poor. So some people that would keep them up at night. Other people, having a mortgage in retirement keeps them up at night more so than whether they have money in the bank. And then the next part of that is, okay, you want to pay off your mortgage. How are we going to do that? Do we have assets we could do that with? Ideally, we have cash, bank accounts, treasuries, money market, CDs, all of that. Or we have investment accounts like brokerage accounts that, have stocks and bonds and money markets. That's the best place because it's liquid and there are limited tax consequences to paying off the mortgage. Roth IRAs can be another tool. So they're tax free if you're over 59 and a half and you've had it 5 years. So a Roth IRA can make a great source of paying off mortgage, if you want to go that route. And then finally, you have your retirement plans, which a lot of times that's the asset you have. your IRAs, your 401ks. That can have a negative impact on paying off a mortgage. I'll show you an example on another slide. And so, do you want to pay off the mortgage? Is it going to make you sleep better at night? But then also, is there a financial benefit to paying off the mortgage? So let me give you an example. So let's say you had a $100,000 mortgage at 4%. So, fairly typical. So your interest cost each year is $4,000. So if you're going to pay off the mortgage, you can look at it like, okay, I am now earning $4,000 because I don't have to pay the interest to the mortgage company anymore. If it's deductible, if you're actually deducting your mortgage interest, which a lot of people don't anymore, at a 25% tax bracket, really your interest cost is only $3,000. So the way to look at that is, okay, I no longer have to pay 4% to the mortgage company. So I am saving either 4% if I'm not deducting the interest, or 3% if I am deducting the interest. So that's the way to look at it. I'm earning now 4% or 3% on that payoff of the mortgage. And so then the question is that a better return than whatever I have that 100,000 sitting in today? So, if it's tax free, like in a savings account or a Roth IRA or something, that's the equation. That's your hurdle rate. Would leaving it where it is earn me more than 3 or 4%? If so, then maybe you want to keep it, not taking into account the fact that it might just make you feel better and sleep better knowing the house is paid for. On the other hand, if all we have is an IRA, the government owns 25 to 33% of that IRA. So if you wanted to pay off your $100,000 mortgage and we have to use the IRA, you're going to have to take out $133,333 because the government's going to get $33,000 of that because that's their share of the IRA because you haven't paid tax. So now that lowers that rate of return down to 2.25. And so you can see it's like, you're not getting a great rate of return by using the IRA to pay off the mortgage. Some people may say, that's fine. I just don't want to have a mortgage payment in retirement, and that's perfectly okay. But so that's the analysis is, do you want to do it if it's going to make you feel better, but then does it make financial sense? Is it going to help or hurt your financial plan to do that? Okay, so now that's paying off the mortgage. We talked about aging in place. The next one is, excuse me, if you're going to age in place, one of the options is to use a reverse mortgage. And I know for a lot of people, reverse mortgages have a negative connotation. When they first came out, 30 some odd years ago, they weren't a good tool. There were a lot of costs. You'd hear stories about little old ladies losing their home because they couldn't, keep up with the upkeep of the home, and therefore the reverse mortgage would get called. That is not the case now. There's a lot of protections built into these things. They can be a very valuable tool, and I'll talk about the pros and cons in a second. And again, we're acting as an investment advisors and financial planners. We have no skin in the game whether a client uses a reverse mortgage or not. So we can look at this independently and neutrally and decide whether it makes sense for you to do these or not. So if we're going to make a recommendation, you might want to consider this. It's because we think as a fiduciary, it's a good option for you. So what a reverse mortgage is essentially is it's a way to access your home equity while living in the home. So you can tap into that home equity without having to sell the home. Now it is a mortgage. The difference between a reverse mortgage and a regular forward mortgage is the mortgage is still going to have to be repaid. The difference is with a regular mortgage, you're amortizing that over 15 or 30 years, and so you're paying it off as you go along. A reverse mortgage is the opposite. You don't make payments on that. You can, but you don't. And so what that does is that frees up cash flow. Because, if you had a $2,500 mortgage payment and you switch that loan to a reverse mortgage, You still have the same loan, and the loan will actually increase, as we'll talk about in a second. However, you don't have the $2,500 a month mortgage payment anymore. So that frees up cash flow for retirement. So the way these things work is because there's no interest, no payment, the loan is going to increase. So the interest, let's say it's 5% interest, it's going to accrue to the loan. So the loan's going to get bigger and bigger and bigger until it's actually paid off. Now you can make interest and principal payments. And so sometimes we'll design it so that, okay, we're not going to pay off the principal, but we'll just make the interest payments. And so that the loan doesn't grow. And so you'll have a small payment, but you'll end up just paying off the loan when you either move out of the home or you pass away. So the way these work is the loan is repaid when you leave the home. So if you leave the home at death, the house is sold, the loan gets repaid, the remaining equity gets paid out to your heirs. Or if you're going to sell the home and trade down, or you have to go into a nursing home, the loan has to be paid at that point too. And so typically in those scenarios, you're going to a nursing home, you're going to sell the home anyway. And so then the loan would be paid off. One difference with these is you can never owe more than the value of the home. You're paying for a feature called a non-recourse loan, meaning if the loan grows to $500,000 and the house is only worth $400,000, you only have to pay back the $400,000. And so it's an important feature. It's like you never end up underwater in one of these reverse mortgages. All right, so how do they work? You can't do a reverse mortgage until age 62. Now there is a way to do them at age 60, but generally you're going to be 62. You can't have a regular mortgage and a reverse mortgage. So we can use the reverse mortgage to pay off a regular mortgage, and so then you just have the reverse mortgage. There's also a maximum loan available that's based on age and home value. So if your house is worth $1 million, they're not going to give you $1 million reverse mortgage, because everybody knows the loan's going to increase. And so there's a calculation that's done based on your age and the interest rate and all that. And so, $1 million home, they may only loan you $500,000. And so, again, that's based on your age when you take it out, et cetera. One important feature of these is qualifications based only on the home value and your ability to pay, for your property insurance and all of that stuff. So, the problem a lot of times is, you want to take a loan out against the home, say a home equity line of credit. If you're retired, you may not qualify because you may not have the income to qualify. A reverse mortgage, it's what home equity do you have? And that's based on the qualification. So you can qualify for one of these whether you're working or not. You pay this fee to HUD, which makes the loan non-recourse, which I mentioned, if the mortgage is $500,000, the home's only worth $400,000, you owe the $400,000. And there's a variety of loan options. There's fixed rates, there's flexible interest rates, there's lines of credit. There's lots of different ways you can do these. And so these modern reverse mortgages are actually pretty handy in certain circumstances. So now there's a bunch of different ways you can use these. And what most people think of is when they do a reverse mortgage is you're going to get like a monthly payment. So you're just going to turn your home equity into a monthly payment. Honestly, that's probably the less frequent way we use these. I think the first way, the most important way we use these is to pay off an existing mortgage. So I mentioned before, you got a $2,500 mortgage. It's a small mortgage, but that doesn't matter. The payment's still the same. So we could just do a reverse mortgage. Let's say it's a $100,000 loan that's still on there. We could take a reverse mortgage loan for $100,000, but that $2,500 a month mortgage payment goes away. And so now you've got an additional $2,500 to live off of. And, you're using up some of your home equity, But a situation like that, you're not using up a lot of your home equity, but you just freed up substantial cash flow for retirement. You can receive monthly income. You can turn them into what are called 10-year payments. So, again, say it's $1 million home, and they'll loan you $500,000 in a reverse mortgage. They could spread that $500,000 over lifetime payments. And that's one way to use them, and that's the way they were first designed to be used. If that's the only source of cash flow that's available, that's an option. But a lot of times, if we've done proper planning, we can use them in these other ways. You can do a reverse mortgage to trade down too. So you can essentially buy a new house. When we talked about trading down, you generate the cash from the trade down rather than putting it all in the new house. And now your house rich and cash poor. You could make a down payment like you would with a regular, home purchase, and then have a reverse mortgage instead of a regular mortgage. So you'd have a mortgage on the new home, but you'd have no payment. And then another way I really like to use these is with a line of credit, where you just tap into it when needed. And so that could be for home health care, that could be for big home repairs, things like that. And then I'll talk on another slide about how we can use it for portfolio protection, which can work really well when there's a market downturn. So let me give you an example here. So 65-year-old, $400,000 current home value. This number is a little old. It's a couple years old, but the max that they would loan you would be $165,600. So you could get a line of credit for $165,600 to start. You just tap into it as you need it. Now, the nice thing about the line of credit is it grows as you get older. So that you may start at $165,600. If you don't take any, that line of credit gets bigger and bigger and bigger based on the interest assumptions. And as I mentioned, there's no need to qualify based on income. So you can take one of these out, whether you're working or on Social Security or whatever. You can use one of these. So again, here's the example. The home's worth $400,000. Starting loan's $165,000. In 10 years, the home's worth $500,000. The loan has grown to $300,000. Again, you're not making the payments, and so the interest is going to accrue and the loan's going to grow. And let's say 10 years from now you sell the house. You either trade down or you move out of state or you move to a nursing home or whatever. So the reverse mortgage of $300,000 will be repaid, and you'd receive the $200,000 difference. Or if this is a situation where you passed away, your heirs would receive that $200,000 difference. So in the worst case scenario, the home is worth $500,000, the loan has grown to $600,000, the house would be sold and the loan would be repaid, and you'd walk away with nothing. That's very rare because they're not going to loan you enough money where you're going to end up underwater. It's just not the way these things work anymore. Okay, now here's a way I really like to use these, is what I call portfolio protection. So what we would do is we would line up that line of credit. We wouldn't necessarily tap into it right away, but what we would do is when we have a downturn in the market, let's say we have a big drop, a bear market, if we've been pulling you $5,000 a month and now the market's down 20%, that's what we call sequence of returns risk, and it can really devastate your portfolio. So what we would do here is, okay, the market's down. Let's shut off the distributions from your portfolio, and let's take $5,000 a month from this reverse mortgage. So that way, you're receiving this $5,000 a month from the reverse mortgage. And I forgot to mention the reverse mortgages, because it's a loan, the money you receive is tax-free. And so we can send you $5,000 a month tax-free. And then when the market recovers, you can just shut off those distributions, and you could repay the loan if you want, or you just go back to taking the money out of the portfolio. And so you could take tax-free income from this during those periods where there's a bear market. And there's been a bunch of studies by academics that have shown this greatly improves your retirement success. So again, you'd have a few costs to set up the line of credit, but you could have this in your back pocket and situations where, there's that market downturn or you need to have a big expense, we can pull that money tax free and leave the portfolio intact. So let's talk about the pros and cons a little bit here. So the cons, it's a mortgage. You're going to pay interest. The interest is going to be similar or slightly higher than it would with a regular mortgage. You also have to pay this, I believe it's an extra 0.25% for the non-recourse feature. So yes, you're going to have interest costs. You're going to have normal mortgage closing costs, just like you would a regular mortgage. They're not really higher. They're similar. You can't do one of these prior to 62 for the most part. And again, just know you're not paying the payment, so the loan is going to grow. For some people, that's a big deal. For other people, it's not. It just depends on how much home equity you have and all that. And then the loan has to be repaid when you die or move out. So, if you're going to age in place and your plan is to stay in the home as long as humanly possible, this could work out really well for you. You've got to be able to pay for the upkeep. So you still have to pay for your homeowner's insurance. You still have to pay for maintenance of the home, all of that. And if you don't, that's when, the mortgage company could foreclose on you. And that's what you saw back 30 some odd years ago when little old ladies were having their homes taken, because they gave them so much money in the reverse mortgage that they didn't have anything to, pay for their upkeep and stuff. And then they lost the home. And then, this may or may not be important to you, is like the legacy value of the home is reduced. And the way I kind of like to look at that is, let's say you've got $1 million home and now you've got a reverse mortgage that's grown to $500,000. So yeah, you've got $500,000 of home equity. So the value has been reduced. On the other hand, if you needed that money to live off of, you would have been spending $500,000 of something else, an IRA or a 401k or whatever. And, if it's an IRA or 401k, it's going to be even more reduced. And so it's like one of your pockets is going to get reduced. Either it's your other assets or your home. Which one is more important to you? In my experience of doing this 40 years, a lot of times the family home gets sold when the people pass away anyway. And so, maybe sometimes that legacy of the home is important. I don't think it's as big a deal as a lot of people make it out. So the pros, when you take the money out of a reverse mortgage, whether you're getting monthly payments or whether you're doing a line of credit, it's tax-free. It's a loan. The no payments equals increased cash flow. And like I said, there's lots of different ways you can use this. You can have cash payments. You can have a line of credit. You can use it to buy a new home. You can use it to pay off an existing mortgage. You can make payments. There's nothing that says you can't pay the interest or make principal payments. So if you want to keep the loan from really ballooning, we can work out some payment in your spending plan. And then finally, you can take out one of these as long as you have home equity. It's not based on anything else. So it can be an attractive tool. It may not be for everybody, but it's something that can be really helpful to you. Okay, so now let's talk about trading down. So either you can't age in place, or maybe you don't want to age in place. Maybe you want to sell your home and move, to warmer weather. Now, we live in Southern California. I don't know where you're going to move to that's going to be warmer than here. But for other parts of the country, to get out of the snow or something like that, New Yorkers moving to Florida, whatever. A lot of times you want to move closer to family. Both of my kids are on the East Coast. My son's in Nashville. My daughter's in D.C. We don't get to see them that often. Now, this is something I kind of like to caveat, though. It's like, your family moves somewhere else. If you follow them, and, they may move somewhere else again. And so, you got to put a lot of thought into whether that makes sense or not. Now, sometimes you're moving there simply because you're going to live with them, or you need to be close to them to, receive family support or whatever. Some people move for tax reasons. We've had lots of clients move to Nevada or, Tennessee or Texas for tax reasons. Some people have will move for political reasons. Some people, they'll have multiple homes. They'll snowbird. So, maybe they have a home in Arizona for the winter and a home in San Diego for the summer, things like that. So, those are all options. And then sometimes you either financially have to, or, you want the lower cost, or you want a smaller home. So lots of reasons to trade down. And again, these are just discussions you need to have. It's like, are we living in our forever home? Do we want to age in place? Can we age in place? If not, are we going to trade down? Where are we going to go? And what can we afford? All of those kind of things. So let's talk about the tax consequences of selling your home, because if you're going to sell, there may or may not be capital gains. So the way it works when selling your personal residence, your selling price over your cost basis is capital gains. So there very well could be capital gains when you sell your home, depending on what the value is and how much you paid for it. So your cost basis is two components. It's whatever you paid for it way back when you bought it. Maybe you bought the home 30 years ago for $100,000, but you also get to add in all of the home improvements you've done over those 30 years. So if you put in new roofs, you put in patios, you put in fences, flooring, kitchen remodels, all of that, you get to add those to your original purchase price, and that becomes your cost basis. And then your selling price is your actual sales price less all your selling costs. So your realtor, your escrow, etc. So the difference between those, between the net selling price and your cost basis, is your capital gains. And you may or may not have capital gains because each person has a $250,000 exclusion. I'll talk about this more in another slide. If you're a married couple, you have a $500,000 exclusion. So the way this capital gains exclusion works, as I mentioned, it's $250,000 for single, $500,000 for a married couple. The rule is you have to have owned and lived in the home for 2 out of 5 years. So essentially, the old rules we had is like it was a one-time deal. But this is essentially every 2 years you get a new $500,000 exclusion, if you've sold and bought another home. So we can subtract that exclusion from the capital gains, and you may or may not have any gain. So here's an example. Let's say the home's worth $750,000. The cost basis, which what you paid for it plus what you've done to it, is $375,000. Plus we subtract the $250,000 gain exclusion. So I'm assuming this is a single person. So you'd have capital gains of $125,000. And we assume maybe you're in the 15% capital gains bracket. You'd have $18,750 of capital gains. If you live in California, there is no capital gains bracket, so you'd pay 9.3. So you'd have total tax of $30,375. Now, capital gains brackets can be 0, they can be 15, they could be 18.8 or 23.8, depending on your income. So if, in this example, it's a 15% cap gains bracket. If you're selling a multi-million-dollar home, it very well could be, you're going to have a lot of capital gains, and you could be in either the 18.8 or the 23.8% capital gains rate, plus whatever your state rate is. So here's the trade down example. We sold it for $750,000. We had selling costs of $45,000. We paid off a mortgage of $250,000. We had to pay tax of $30,000. So out of that $750,000, $325,000 is going to pay off the mortgage, pay the realtor, pay the government. So you'd walk away with $424,000. So then the question is, can we buy something else for $424,000? And so, that's kind of the decision that has to be made. And again, one option would be, okay, we're not going to take $424,000, put it all into another home. We could put $200,000 and take, say the new house is $500,000, put $200,000 of these proceeds down, take a $300,000 reverse mortgage on that, and then have a couple $100,000 in the bank for liquidity or spending needs or whatever. So the decisions, it's like, do you pay cash for the new home? In that situation, again, depends on what other assets you have. You could end up house rich and cash poor. So yeah, you have a paid off home, but you don't have anything to live off of, or you don't have any money in the bank. Do you carry a mortgage in retirement? Maybe you're trading down and you're still working and you could qualify for a mortgage. It doesn't have to be a huge mortgage. It could be, you put 50, 60% down and you take a 40% mortgage. Do you do the reverse mortgage purchase that we talked about? Or finally, do you even buy a home? Maybe it's going to be better, depending on your situation, to just pocket that money and rent. Is that a better option for you? So in terms of renting instead of buying, the benefit of renting is it frees up cash for future living expenses. So, we're doing the spending plan, and if you have this 400K to help supplement your your retirement income, maybe that's a better deal. You have flexibility and mobility for life changes. So, maybe you don't know exactly where you want to go yet. So maybe you sell and just rent for a while. Maybe you just move into one of those independent living places where, and most of those are month-to-month rent, and they include your meals, and they include all the entertainment and social activities and all of that kind of stuff. So that might just provide you more flexibility. Maybe you're going to do the snowbird thing. So maybe you're going to, rent a house both in Arizona and San Diego, or whatever. Or, down the road you think you're going to go into a nursing home, so maybe you just rent until you have to go into the nursing home. The downsides, the costs are unknown. I mean, if you have a mortgage or you have a paid for home, those costs are known. Here, you don't know what rent increases are going to be like. So there's some uncertainty there. And that's something a lot of people struggle with when they rent is, there's no security and there's no certainty. And the rent payments will never end. But the reality is, if you even own a home and it's paid for, there's payments that never end. You're still going to have to pay property tax. You're still going to have to pay homeowner's insurance. You're still going to have maintenance. And so, those things can be quantified and evaluated, and which one makes the most sense for you. So again, it's just something to consider, that maybe buying another home isn't always the best case for you, and we can run the scenarios and see what enhances your probability of success in retirement. So kind of putting it all together, again, the first decision is going to be made is this our forever home, or at least our home for as long as we can? So if you're going to age in place, then okay, are we going to pay off the mortgage? Should we do a reverse mortgage? What are the costs going to be to make the house available for aging in place? What are the costs going to be if we stay in this home? Then you can make the trading down decision. It's like, where do we want to live? What would we walk away with? And is that enough to buy something else? Are we going to pay cash? Or are we going to take out a mortgage or a reverse mortgage? Or are we just going to pocket the cash and rent versus buying? So, there's a lot of stuff that goes into this, and I've mentioned a couple times now, it isn't necessarily all financial. There's a lot of emotional decisions that go into this, and I've been married over 40 years, and my wife and I may necessarily agree on what we want to do in terms of living arrangements in the future. So, this is where I think we can really help you evaluate all these various scenarios, model them for you, give you our advice on what might be best for your situation, and help you come to some resolution. So how can we help? Obviously, if we're doing financial planning for you, we're already doing the comprehensive retirement income analysis, and we, can plug in these various scenarios. We can help you analyze what it would cost, or is it feasible to age in place? Obviously, there's tax planning involved here. If we're going to pay off the mortgage, what are we going to use to do that? We've got access to a network of mortgage and reverse mortgage specialists, and as well as real estate agents. And again, we're not affiliated with any of them, but we have a network of people that we vetted and we're comfortable sending our clients to. So that's pretty much the end of the presentation. I'd be happy to open it up to any questions if anyone has any. I'll give you a couple minutes to type your questions into the question or chat feature. And this presentation is being recorded. We'll have it posted to our website in the next few weeks. So if you missed part of it, or you want to re-listen to it, or you want to have, a friend or family member listen to it, we'll have it available in a couple of weeks. So, last call for any questions. Alrighty then. Obviously, if you do, you can reach out to myself, Jim at Anchor Bay Capital, or one of our advisors, Rob, Blake, whomever, and we're happy to talk about your situation with you. Okay, guys. Well, everybody have a great rest of the evening. As I mentioned, we'll have this posted shortly, and it'll be available for viewing. Okay, everybody. Thanks for attending, and have a great evening. Bye.